So it's time for the keynote lecture of this conference. This year we are very honored to have Martin Eichenbaum to give this lecture. So it's easier online. We don't have to pay a business class or return trip. So we made money on that lecture. Martin is one of the most famous and important contributors to macroeconomics. He's written on numerous topics from, COVID, we were talking about, from, labor hoarding to COVID to uncovered interest parity to important standard DSG models that are used by everybody. So he's written really numerous seminal contributions. Basically, when I was at Pompeo, I was making fun of the Minnesota school, and this was driving people like Tim Kehoe crazy. But here we have the good side of the Minnesota school, the non-ideological side, the side that is open to controversies and interpretations. And so it's a great pleasure for us to have him today, and he will talk about an important topic, which is the refinancing channel of the effects of monetary policy. That is to say, how constraints and institutions, I suppose, are as important or even more important than behavior as a mechanism for the transmission of monetary policy. So the floor is yours. I guess you take the time that you need, and then we will open the floor for discussion.
That's great. Well, thank you very much for that gracious introduction. Some of you may have seen earlier versions of this paper. We are on the 10th iteration of a journal, and so this is a very large revision relative to N-1. Gilles talked about institutions, and without having a theory of why this is true, the U.S., most mortgages have fixed rates. And so refinance decisions very much depend, for obvious reasons, on the potential interest rate savings from refinancing versus the costs, which we'll come back to later. And so what this paper really at the largest level does is empirically documents that refinancing and the response of the economy to a given interest rate cut is state dependent, where the state is measured somehow as the potential savings from refinancing. And then we are going to develop a quantitative model that captures those empirical findings, and we're going to study how the paths that interest rates have taken in the past affect the distribution of interest rate gaps, such as the difference between the interest rate that people have and on their old mortgages and what they could get if they refinanced. How do those things affect the potency, if you like, of monetary policy? So, and I think this, I hope that the paper highlights some interesting new trade-offs in the conduct of monetary policy. So we all know that in response to the financial crisis, the Fed kept interest rates low for an extended period of time. If you were paying attention to the news yesterday, you know that the Fed announced they're going to keep interest rates low to at least 2023. And so there are many, many good reasons to do that, but there is an interesting potential cost, which is, I'll argue, that a period of low interest rates like that reduces how powerful monetary policy will be once we renormalize. And so I want to quantify that. And so how big is that effect? Well, in this paper, we do some experiments to say when interest rates are below their steady state value, say for 6 years, that is under the assumption that that we are seeing interest rates below their steady state values. That would mean in the model, the monetary policy is less potent for up to 2 years after renormalization. And so that has some practical implications that policymakers want to think about. Okay. Well, so how do you measure the potential savings?
Can I just clarify? When you're meaning potent for monetary policy, you mean both on the up and the downside, or mostly
No,
on the
just
down?
on the down. I'm only talking, as you'll see, there's an asymmetry of this mechanism between ups and downs. And so all of my experiments will be on the downs. And then we can talk about whether that's factual or not, that there's an asymmetry between ups and downs. Empirically, the question is, how am I going to measure or we'll have in the model, but right now, we want some measure of the potential savings that a household would realize if it refinanced, right, given its current mortgage rate. And obviously in the real world, the savings depends on a lot of stuff, right? Like obviously the old and new mortgage rates, but also how big your balance is and the exact refinancing strategy that you pursue as a household. And so try as we wanted to, we could not come up with a simple non-parametric summary statistic for all potential savings. I don't think that's going to be possible, but what we did do is try a lot of different measures. And the one that I'll focus on today is a very simple, straightforward one, very transparent, and it's the average interest rate gap. So what do I mean by that? Well, I'm going to look at the current interest rate that lots of different kinds of consumers have. And I'm going to compare that to the mortgage rate that they could refinance at. Okay. So if we, just in notation, so I'm going to have very micro data, which we'll get to in a minute. And so if you look at individual I, I'm going to look at, I'll define their gap as the difference between their old interest rate, which I will observe, and the interest rate that person I has on their current mortgage. And I'm going to condition on a lot of characteristics of that individual, because they may be in different locations, they may have different characteristics. Some obvious things would be their FICO score bins, that goes back to something we talked about earlier today, their region of residence, but we're also going to look at lots of things like loan-to-value ratios, mortgage balances, characteristics of the particular place they live. I won't get into that detail, but that's in the paper. So it turns out that that distribution varies a lot over time in the United States. So over here, I've just given you two histograms, if you like, of that interest rate gap in 1997 and in the year 2000, two just different dates in the United States. And you can see in 97, the distribution is to the right of the distribution in 97. And so it looks like a thicker tree to pluck, right? There's a lot of potential gains that can be had in one of these time periods by people refinancing that they wouldn't have in another period. And of course, it'll be a challenge. Why do you ever have any interest rate gap? That'll be something that we have to confront in the structural model. But for now, let's just take it as a given and just think about the data. This is a really ugly slide, but there are a couple things I want you to see here. For now, so let's think of the left-hand side variable in a regression as being the fraction of mortgages that are refinanced in a county. We have county level data between quarters T and T+4. So that's the left-hand side. So I'm trying to explain that. Then I've got a bunch of stuff on the right-hand side. So we're going to have, county fixed effects, time-varying macro controls. Like, what would that be? Well, forecasts for growth, forecasts for inflation, unemployment, things like that. We're going to have county level controls. The most interesting things, though, might be this term over here, beta 1 times delta RM. So that's just the percentage fall in our measure of the mortgage rate. And then I have an interaction term between delta RM and ACT minus 1. So what's ACT minus 1? That's just going to be the average level of the interest rate gap. One could look at different moments of that distribution. For today, I'm just going to focus on that mean effect right there. So if you're like me and used to time series, you always have to think really carefully about this. And if you're lucky, you have a co-author like Arlene who was patient with you. So what beta 1 is going to be, it's just going to be the effect of a change in mortgage rates on refinancing rates when this interest rate gap is 0. And beta 2 tells you what's the effect of how does that effect of the interest rate change depending on the mean of the interest rate gap distribution, right? So beta 2 now is what's novel, if you like, in the empirical work that I'll talk about right now. So as soon as you think about this regression, you realize, well, there's endogeneity all over the place. So I'm going to have to instrument for that interest rate, the delta RM. And so what we're going to do is just use high frequency data, sort of very standard technique by now, either using federal funds, futures rates, or treasury yields. And that's going to be our instrument. It turns out it's a really good instrument. So not to belabor things, for example, if you just regress the mortgage rate on that measure of a monetary policy shock, the first thing that you find out is that mortgage rates do respond strongly, say to 100 basis point identified shock, right? So this is 60 basis points, pretty big standard error, but still it's there. The F statistic on the first stage estimates exceed the magic number of 20. And if you do Stock-Yogo type tests, you would certainly reject the null of a weak instrument. So it appears that, you know, these Fed funds futures, high frequency objects, or the treasury rates are big. These may surprise you how big they are, but if you take sampling uncertainty into account, they're very much in line with Gertler, Karate. I think they had things going from 20 basis points to 50. So nothing out of the ordinary there. Okay, so first let's look just empirically at the response of refinancing to a monetary policy shock. And I'm going to do this slowly. There's a bunch of numbers here, but I always have to do this slowly for myself. And the first thing to notice is in this data set, the average refinancing rate is about 7.9%. So that's, you know, of the stock of people out there, that's the average number that are refinancing. And suppose that mortgage rates fell by 25 basis points. If we started at the mean interest rate gap, which turns out to be minus 14 basis points. So on average, it's actually negative. People aren't leaving money on the table. Then refinancing would increase by 10 basis points. Okay, not very much. It would be beta 1 times 0.0.
Martin, there is a question.
Yes.
Is it possible for bankers to penalize financially borrowers that decide to refinance at another bank?
I think so there are different types of mortgage rates out there, and there are some mortgage rates in which you would pay a penalty for refinancing. I don't believe that it's generally the case that that penalty depends on whether you refinance at that bank or not. That would just be a competitive market, roughly speaking. They might give you a little sweetener if you refinance at that rate. We are looking at, and so I'll talk about in the model, the costs of refinancing, which could either include prepay penalties or could include the fixed costs of a new mortgage. Generally speaking, the mortgages we're working with do not include penalties for refinancing directly. In Canada, that might be different. So this goes to another point Gilles mentioned, which is the institutions very much matter across countries, and we can use the model to think about how those institutions would affect the potency of monetary policy. So I hope that answers that. The important point here is to notice then that if you're starting at the mean of the average interest rate gap, you know, a 25 basis point cut in the mortgage in mortgage rates leads to a 10 basis point increase in refinancing rates. But now imagine, and this is just repeating that information. So you would go from 7.9 to 8.0 percentage points. But now imagine that we start off at an interest rate gap, at an average interest rate gap that's 1 standard deviation from the mean. That would mean that the average interest rate gap is 56 basis points. Now imagine starting from that, you cut the mortgage rate by 25 basis points, then the refinancing rate would increase to 12.6 percentage points. So the marginal impact of a 1 standard deviation increase in the average interest rate gap is 4.7%. So that's a very substantial change. So think about this 4.7 relative to that 7.9, you're getting a much bigger kick, right, relative to that average. Now, of course, I can use that estimated regression, if you like, to just graph. In this case, I don't know why, but it's a 50 basis point reduction in mortgage rates on refinancing rates at each point in time in our sample. So we can say, given that regression, you know, how much kick are you getting in 1995, 2001, 2004? And the point is that that kick is really varying over time. So there's something for us to talk about that's relevant for an actual policymaker. Now, this is going to be really central to our model, and you might know guess from theory, that cash out refinancing is very important because what is that? That's when the balance of the new mortgage is higher than the old mortgage, right? So you're taking money out of your house. And Mian and Sufi and others have argued that this is an important source. This type of refinancing is very important for people to increase their consumption. And that also means then in our model that it's going to play an important role in determining the effects of changes in interest rates on consumption. So that too will be state dependent. So now what we're going to do is get this data at the county level and look at the fraction of loans that are specifically tagged as being cash out refinancing. Again, I'm going to be a little pedantic because the numbers here are really very important. So now imagine.
Just make sure that I get it right.
Yes, yes.
By this, you mean that I'm borrowing additional money
Correct.
compared to the outstanding mortgage?
Yeah, so suppose that your old mortgage was, you could either be taking out equity, you could have built up equity, right? And now you're taking some of it out in the form of a new mortgage, or the house could have appreciated.
Yeah, right.
So for whatever reason, you will actually have more cash now at your disposal for consumption. So how big are these cash out effects? Well, again, if we start at this minus 14 basis points, remember, that's the average interest rate gap, the unconditional one. And you cut interest rates, you raise the share of loans with cash out refinancing by 1.2%. But if you cut those interest rates when the average interest rate gap was 56 basis points, 1 standard deviation bigger, that would raise the share of loans with cash out refinancing by 4.3 percentage points. So the marginal impact of a 1 standard deviation increase in the rate gap is 3.1 percentage points, and that's large because the average annual cash out refinancing rate is 5.5 percentage points. Right? So this is what you would normally see in sort of over time, an unconditional average. This state-dependent effect, evaluated at 1 standard deviation, is roughly half, let's say, of that unconditional average. Now, how much money does that put in these consumers' pockets for when we think about our model? Well, I can now get data on the change in the balance, the dollars that I'm putting, that these consumers are taking out. Again, not to be too pedantic, if you start at the average level of the interest rate gap, you would get the balance increases, Gilles, so the mortgage that you're actually owing goes up by 5.2 percentage points. But if you started from a higher interest rate gap, that balance would increase by 8.9 percentage points. if you look at the median mortgage in 2007 in our sample, it's about $123,000. So this is not New York or California, or I assume Paris, but it's, you know, across all these counties, but it's about $123,000. And what that means is a consumer who does this would be able to take out $4,700, which is now available for a variety of consumption purposes. Okay, so that just to fix your mind on the numbers. Now, how does this translate into measures of economic activity? And here it's a little more difficult because we're working with county level data, so we have less data than, say, a standard macro person would have. But we do have, for example, unemployment data. I see this got cut off a little bit, so I'll read it to you. So again, estimate the effect of a cut, say our instrumental variables, how it works through mortgages and therefore on unemployment. And what you want to see here is if you had a 25 basis points cut in the mortgage rate exogenously, then when the average rate gap was 14 basis points, you would, unemployment would fall by 0.6% at the county level. But if you started from a situation where the rate gap on average was 56 basis points, unemployment would fall by 1.8 percentage points, which is 3 times as large as that 0.6. So according to these estimates, that interest rate cut would have a much bigger kick. One last indication of another thing that we can see, here's new building permits, and there's the importance of new building permits. It's not housing. That's not what I want you to focus on. It's just a measure of economic activity that I happen to have at the county level. It's also in the forecast of leading indicators, so it's of some independent interest. And here you see a very big difference. Which you cut mortgage rates by 25 basis points, you get a 17 percentage point increase in new permits if you're at that average interest rate gap. But if you started off with a situation where you had 56 basis points average interest rate gap, you would now have a 23.6% increase in building permits. Okay, so again, you see this refinancing, how much people are extracting from their homes, and here the evidence that, or we claim some evidence that there's strong state-dependent effects on economic activity as measured by unemployment rates at the county levels. So just to summarize the empirical portion, I tried to argue that the effect of a change in the interest rate on refinancing is state-dependent, and when the measures of those average gains from refinancing are high, a given fall in the interest rate is going to induce a larger rise in refinancing activity, and also the resulting effects on economic activity is also going to be state-dependent in a very similar way. So that's the first, let's say, 35% of the paper, which is going through the difficulty of trying to substantiate those facts. So we now turn to the question of a structural model, and why bother? I could just stop there, but why would I do a structural model? Well, the first thing is I really do want to quantify the factors that drive those state-dependent effects of monetary policy, and I'm going to do that, or attempt to, in the model. I then want to estimate the state-dependent effects of these changes in interest rates on aggregate consumption, which I can do in the model. And perhaps most importantly, I want to see how the potency of monetary policy is affected by a long period of low interest rates and develop some intuition for why that should be the case. So let me tell you about the household setup. We only have so much time, so I won't go into enormous detail about the math, but let me give you the outlines of the model, the key features. So first, it's a life cycle model, and we go through in the paper and strip out the life cycle to show you how important the life cycle is. I'll come back to that. These individuals face idiosyncratic income risk and aggregate shocks, so they face both. They have assets. They have a liquid one-period asset. They have illiquid housing, that they purchase via fixed mortgage interest rates. We have two kinds of fixed costs when it comes to house loans. In an old version, we just had one fixed cost of refinancing. We now have, we say, if you refinance, there's just a fixed cost. Okay, and then we have some evidence in the paper. I can talk about that. But it's also true that if you want to buy a new house, there's also a fixed cost, and that's proportional to the value of the new house. Okay, so we're explicitly separating between those two types of mortgage activities. Then finally, we have borrowing constraints. So there's a short-term constraint that you can't go negative, but very importantly, there's a mortgage loan-to-value constraint. There are other constraints. Dan Greenwald has done wonderful work on pointing out the importance of debt servicing to income. Our model does not have that. That really considerably complicated, because now you have two nonlinear constraints that are bouncing up against each other. Dan looks at that. We only have the mortgage loan to value constraint. Okay, so let's talk about demographics and preferences. Well, this is a model in which people can live up to 60 periods. They work for 40 periods, and then they retire for 20, and retire is important. Survival is stochastic, but if you make it to 60, you're done with. Okay, so you're not going to live more than 60 periods, but the probability of survival is by A. Preferences are pretty standard here. People care about a couple things. This is person J, age A. He or she cares about her consumption, say of a non-durable consumption good, but he or she also cares about the service flow from the stock of housing. And this is sort of a standard utility function across those two services. These people also care about bequest motives. And the paper talks, and I'll try and give you some intuition. Bequest motives are actually pretty important here. They play some role in getting life cycle dynamics correct. And these are not infinitely, these are, I forget what this, they get direct utility from the bequest, so they don't have infinite horizons. Okay, so they like leaving W if they pass on. What about the labor income process of people? Well, it's reasonably rich, not infinitely so, but if you think about a person, household J, who's age A at time T, there's a fixed effect for that person. They have idiosyncratic income, A to JAT, but they are also sensitive to aggregate income movements. So if aggregate real GDP moves, that's going to affect this person by a factor phi A. Okay, so this captures that there's an age-specific component of sensitivity to business cycle fluctuations. What do people get when they retire? Well, here we're going to proceed as in Guvenen and Tony Smith, and we just assume people, as in the data, they receive retirement income that's a function of their labor income earned in the year before retirement. So we're just lifting that from them. So no novelty there. Mortgages are pretty straightforward, and it relates to something Gilles asked at the beginning. So think about Mr. or Mrs. J, who enters a loan at age A and date 0. He or she has this fixed rate on that house, so there's no variable mortgage rates. They're all fixed rates. And they have a payment of M, which is subscripted by J, A, 0. So their principal evolves in a very straightforward way. This is the interest rate on what they owed. This is the payment that they make. And then we figure out what their principal is going to be at T+1, given using this little difference equation. This is a little controversial. We are going to amortize. So there's a question of how long should these mortgages be, right? In this draft of the paper, they're pretty long. They're amortized over the remaining life of the individual. So that obviously is not quite right? Because in practice, everybody gets a 30-year, a 15-year. We try to calibrate this, and for basically for model solution techniques. People just amortize the mortgages over the remaining life of the individual. We have solved it for 30-year mortgages. We have solved it for 15 years. Nothing qualitative changes, but some of the numbers are obviously going to change a little bit. If you're just refinancing, you pay a fixed cost. I forget what letter this is. Let me call it fee refi. If you're doing it to obtain a loan on a new house, you pay a fixed cost that is proportional to the value of the house.
Marty, just on this assumption of the amortization of a remaining life. So in practice, I wonder the extent to which this is important. If you had a 30-year mortgage, now it's only 25, and you refinance to a 30, there is a component of the reduction in payment that just comes from the fact that you're doing the maturity extension, right?
No, that's right.
So that might amplify relative to what you have in terms of the consumption effects relative to what you have. So maybe you could argue for it's like what you're getting is a lower bound.
Yeah, no, that's right. I mean, what we actually did was in the appendix solve it under two different scenarios. But I think qualitatively what you're saying is exactly correct. It's exactly correct. There's just some hard choices that have to be made when the model gets this big and this complicated.
You're adding a state variable. I understand why you're not doing it. I'm not suggesting you should. I think that there's maybe a way to argue that that it's actually a lower bound than in that case.
It's totally fair. Totally fair.
Excuse me, just a stupid question. But shouldn't the principal fall to zero at some point?
Excuse me? Well, you set M.
Isn't there a relationship between big R, big M, and the maturity of the loan or something?
Yes, absolutely. So you have to pay it off. You have to find that M and that R such that you're paying it off over the length of your life.
Okay.
So absolutely. There's a maximum allowable mortgage, so you're allowed to have a mortgage that's some percentage of the value of your home, right? So that's the loan to value ratio. And this will apply if the loan is new or if it's a refi, okay? There's a short-term asset constraint, so people can, in this version of the model, people can save at some constant interest rate. We'll see that, but they can't borrow at it for consumption. So this is a value function fiesta, as you can imagine. And so if you think about the value function for a typical individual, there's four states, if you like, that they can be in. They can be a renter. So you could just rent. You could purchase a new home, in which case you'd pay a fixed cost proportional to the value of the new house. You could own and refinance. So you would, both the balance and the mortgage rate can adjust. You'd have to pay a fixed cost. And of course, you can own the home and choose not to adjust the loan. So this would be the fourth thing that you're at. In each case, we can define the value function associated with that, with that particular state. So what are the state variables in this model? And this will come back to the point that Adrian raised. There's a lot of them, right? So there's your idiosyncratic labor income. There is, there's your age, there's your idiosyncratic labor income, and there's your asset holdings. So what are your asset holdings? These people can hold short-term assets, a stock of housing, a mortgage balance, and their existing mortgage rate, right? Those are all state variables. But these people also care about the aggregate state the way we've set this model up. What would they care about? Well, they care about the log of real GDP because their income depends on that, and also they have to think about the future. They care about the price of houses. They care about the interest rate, and they care about the average savings from people refinancing. Why do they care about that? Well, if you think about the reduced form of this model, it's nonlinear. So we have to assume, at least going in, that whatever the time series representation is that people are using to form expectations allows for such nonlinearities. So here you come to a fork in the road, as Casey Stengel once said, I came to the fork in the road and I took it. You can either go general equilibrium, which is going to be very, very complicated here for a lot of reasons, or you can say, I'm going to do, if you like, a partial equilibrium exercise, but one that's internally consistent, where people form expectations of these variables over here using a time series model. And then the question becomes, okay, which time series model? So what we do is, in Appendix 96, a suite of time series models looking at both linear and nonlinear representations and asking which are good in terms of root mean squared error forecasting. And the one we settled on was the one that's on the bottom of this page, which is pretty standard. There's some first differences, but notice there's a nonlinear interaction effect over here in which the average savings from loans is interacting with with RT. Okay, and it turns out B2 is statistically significant. Now, one referee quite correctly asked, he said, well, okay, you're going to load in state dependency partly from the VAR. Let's call that a VAR. But there are other sources in the model of state dependency. Can you separate them? So we're going to redo the whole analysis where we shut this B2 to 0, and that will let us quantify how much of the state dependency is coming from the, quote, structure of the model and how much is coming from the time series per se. Okay?
Marty, a comment on this or a question.
Yes.
I guess there's two ways to do this. One is to actually just use the data, and the other one is to use model simulated data. And the model simulated data one, it has a flavor of rational expectations. So yeah, which one do you do? Just like, is it just your equation at the bottom? Is it just from data? Or do you also do the pseudo-rational expectations one where you simulate the data from the model and then you re-update?
Well, I'm going to simulate data from the model and generate model log AT, but I'm never going to solve for Y, P, or R. That's always, you'll see in the exercises, I'll go through that carefully. I'm always going to take that from the data, and the VAR in setting agents' expectations, but I am going to use the model's implications for log AT because that I can solve for. I don't have enough structure to solve for Y, P, or R.
Right, absolutely. But the log AT enters your equation, the delta S at the bottom.
That's going to come from the model.
But the log AT you can get from the data or you can get from the model.
I can compare those two. The one that we're going to use in solving the model will be the one from the model. And then I'll compare what the model implies for various other things conditional on that. Okay. So if the model really screwed up on AT, we would get terrible predictions.
Right. Yeah. So that's your building in the rational expectations.
Exactly. Now, one thing, let me just say this, we all know, and this came up in some of the talks, it's very hard for traditional asset pricing models to account for the empirical properties of mortgage interest rates, rental rates, and housing prices, right? It's just really, really hard without, doing lots of interesting behavioral things, etc. So I'm going to assume that the interest rate on mortgages is just a function of the state, and that the rental rate is given by, so remember, in the state I have a short-term interest rate. I'm going to get the mortgage rate from there, so that's easy. And I'm going to get the rental rate by basically a very simple regression on the price of new housing. And it turns out you nail it, right? So if you just regress rental rates on house prices, you do very well. If you did an asset pricing exercise to do that, you would do horribly, as anybody who knows. Rental rates are just don't do what they're supposed to relative to price of new housing over short horizons. They're co-integrated, all that stuff is true, but you're not going to do very well with the standard model. So we want to get that right to focus on the mechanisms that we're interested in. A few words about model parameters. There's nothing really fancy here that, it all comes from microdata, but some things that are interesting that are worth mentioning is the fixed costs. So the refi rate on, the fixed cost on a refi rate, we assume is $2,100, and that was chosen to match the average quarterly fraction of new loans in the model, which is 4.5%. And it turns out that that's very close to the Fed's Consumer Guide to Mortgage Refinancing and some results in LaCour and Little. So those seem to be reasonable. And then the transactions cost of buying a new home is, we're assuming 5% of a house price. And there's a variety of references here, including Berger et al., which argue that that's a reasonable number. I mean, again, I don't want to be too precise here, but it's a reasonable number. So now you solve the model, which is not entirely trivial, because it's a pretty complicated model. And a couple things you want to see here is it does pretty well with respect to life cycle moments, and the paper goes on to some care about why that's true. The one thing that's interesting is notice that non-durable consumption is coming down. And you might say, why is that? That's where those bequests are important. You want these older folks to really care relatively more about bequests as they get older. And so they're selling, they're resizing their houses. They're doing a lot of things, including cutting back on non-durable consumption later in life in order to get those bequests. Let me just say that. And why are they building up their non-durable consumption? Well, they're liquidity constrained. They have to pay, they have to save up for their initial mortgage down payment. And so you're getting a nice life cycle pattern. So now let me just go through the steps of the model fit. How do we actually solve this model and compare it to various things in the data? So imagine that we start in 1994. That's where our data starts. And I take the distribution of people's assets, liabilities, and mortgage rates that are observed in the data. So that's my initial condition. I have about 100,000 households in this model economy. I have a distribution of all the idiosyncratic shocks that are affecting them. So draw for each of them. Feed in the actual values of RT, that's that short-term interest rate, real GDP, and the price of housing from 95 to 2007. Use the model to construct a time series for AT. This is the log of that average interest rate gap. So that's coming from the model. Then use that variable in the VAR, in the nonlinear VAR that I estimated, to let people form expectations about their future values that they need for RT, YT, and PT to solve their dynamic programming problems. So at every point in time, if I do that, I will have a distribution of interest rate gaps and refinancing decisions for these 100,000 people. Given that distribution, I can compute any moment of that distribution that I'm interested in, both in the model and in the data. So what we do a lot of this stuff. Let me just give you some of the key things that we see given the time constraints. This is the propensity to refinance given a mortgage rate gap. So you see here at each object here, this is, if this was your interest rate gap, this would be your propensity to refinance. In this case, we're nailing it. You see a little bit of distance here, a little bit of distance here. Once you get to the bigger than 2%, you get some crazy people. This is known as the burnout rate. There are some people, rich doctors, etc. If I had done this, say, for more than 5%, there's some guys people who never refinance. But the model does a pretty good job, if not perfect, in matching this particular aspect of the data. A really cool thing that I thought, this one thing that we did, I showed you this original regression of state-dependent effects of a mortgage rate reduction. Well, here's the data. Those are the numbers. You don't remember the numbers, but that's what we got in the data. I can run the same regression. I don't have counties, so I'm not going to have that in the regression, but I can run the same regression up to that in the model and in the data, and here's what you get. These are p-limbs, okay? And notice these are, this number is within, you get the strong state dependence in the model that we see in the data, and it's actually, the number is quite reasonable. Where does that state dependence come from? Well, these agents face refinancing costs, right? And so when those that's going to automatically give you a state dependency. This is the graph that I showed you earlier on. If you remember, this was at each point in time, using my regression coefficient, what the effect of the refinancing rate was of a 50 basis point. That's the blue. The dotted lines are standard errors. The yellow is what our model gives you. And again, certainly not perfect, but up to sampling uncertainty, it's not bad. Okay, so the model is capturing that aspect. The model is also going to give you state-dependent effects on consumption, right? So I can run this regression in the model. I can say, what would the effect of on consumption be of a change in mortgage rates with a 50 basis point fall in mortgage rates? The total effect would be, if I just run this regression, if I cut mortgage rates by 50 basis points, I'm going to get 2.05% change, or percentage, these are logs, percentage change in consumption. The direct effect of beta 1 would be 1.21. So that's what you might get, say, in a linearized model for a variety of reasons. It could be intertemporal substitution, it could, all the normal stuff. What's going on here, though, is this is a very nonlinear model. The state dependence is adding 85 basis points to that 1.21% that you would get in a linear model without state-dependent effects. Okay, so it's not half, but it's a big number. It's a big number.
Marty, can I ask how you think about this versus some say of the VAR evidence or numbers from the DSG models? Because it looks like a big effect. 50, for a 50 bip, you get 2%. That's like an elasticity of 4.
Yeah.
And so,
are you worried about the 85 or the 1.21?
No, I'm just curious. I guess there's a question in the model what your elasticity of intertemporal substitution is, and also how that relates to evidence that, say, consumption responds to interest rate cuts, but not by enormous amounts. It's not the most cyclical component.
So what's going to happen here is it's going to turn out that liquidity effects are going to be critical. It's going to be this cash out effect. So it's not going to be consistent, say, with Cristiano, Eichenbaum, and Evans, simple intertemporal substitution effects. But it is going to say that to the extent that you have liquidity constrained consumers that are cash out financing, I'll get to that in the next slide, that's a really big deal. So in many ways, it's very consistent with the spirit, if you like, of Hank models, but it's emphasizing a different type of market imperfection, a different type of mechanism that isn't intertemporal substitution.
It'd be interesting to break it down in the model, actually. See how much is it.
Here's the model. Here's the model. So suppose I look at the effect of an exogenous change in mortgage rates for two kinds of consumers, constrained consumers and unconstrained consumers. It's huge for constrained consumers. It's like 4 percentage points for constrained consumers. It's much smaller for unconstrained. Note, this is the total effect, so it's the beta 1 plus the beta 2 effect. So the consumption response is predominantly driven by the constrained households in the model. And of households who refinance in the model, 80% are engaging in cash out refinancing. And that's roughly in line with evidence by these guys. I think they have like 73% or something. So the big effect here is coming from this cash out refinancing. And if you condition on folks who do cash out refinancing, they increase their loan balances by about 27%. And that's consistent with micro evidence from Buta and Keyes. So to circle around to what you were saying is, yes, it is not consistent with the mechanisms in standard DSGE models. It is consistent with a larger vision of what those models, where they should be going.
Basically, that is the story that, okay, I cannot borrow more than a fraction of the value of my home. When interest rates fall, that value goes up.
Well, it's called so.
Equilibrium, and this relaxes my borrowing constraints.
It's not quite that, Gilles. Let
No.
me two things. So let me break it down a little bit. It is true that if in general equilibrium, the value of the houses goes up because interest rates fell, when you choose to refinance, you will be able to refinance even more than you would have. So the effect that you were worried about is there. But even if it didn't, when interest rates go down, if people have built up equity, they can take some of it out. So if they weren't up literally against their borrowing constraint now, they can take some equity out. They can take out a bigger loan. It's also true that if that interest rate is when they go and the value of their home has gone up, they can take out even more. So they're both channels, one, the GE channel that you thought about, and the one that I think actually in this model is actually more important. I can just suck some equity out of my house because I was probably paying down the loan. And I can take that back. Or also remember, these are life cycle guys. So if you took out the mortgage when you were young, you now, because we have wages, right, are following an age path, right? Your wages are going up, your income is going up, and you are able to do different things with the mortgages that you couldn't do before. So for a lot of reasons, you're less constrained over time for life cycle reasons. Should be careful with time. The paper goes, I should say, the paper tries to deconstruct a lot of these experiments very carefully along the lines that Adrian was talking about, and that would help, I think, answer Gilles' question very concretely. But I hope I gave you a flavor of what the key mechanisms are. Okay, so let me end in the next 5 minutes and leave a little bit of time for discussion. I want to get to the implications for monetary policy. So I'm going to do this in two steps. One is I'm going to look at the effect of a monetary shock that's preceded, for example, by a history in which interest rates were going up. So that's going to be this line, and then I'm going to cut rates. I'm going to compare that to a world in which we just started at steady state, and then I cut rates. And then I'm going to compare that to a world in which rates were falling, and then I cut rates. Okay, and we'll try to get some intuition for why policy would have different effects. A given size policy would have a different effect. There's lots of numbers here which are meaningless, so I'm just going to go to this. Suppose you start from steady state. So let's focus on this medium one over here. In this model, if you cut rates from steady state, how big is this cut? I forget. I think it's a 50 basis point cut. Yeah, it says 50 basis point cut. 16% of the people are going to refinance in the impact period of the shock, and aggregate consumption is going to go up by 1.7%. So that's across all the agents. Why is that effect so big? Well, if you think about it, if we're in steady state, everybody has a mortgage rate at this number. And when I cut rates, everybody in principle is going to benefit from refinancing. So you're going to get a big kick. Now imagine that we think about the situation where rates were going up and then you cut rates. So we think about this path over here. So you're going up, 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 and then you cut. Well, in that world, only 9% of households refinance. That's smaller than the number we just saw. The previous number was 16%, so we cut it to 9%. And there's a much smaller rise in consumption. And why is that? Well, when rates have been going up for a while, only 31% of the people face positive interest rate gaps when that interest rate cut happened. Who are those people? Like, why is anybody facing an interest rate gap? Well, there's a bunch of people who had new mortgages because of life cycle considerations or idiosyncratic income shocks. They had to buy mortgages at high interest rates, and now the Fed came and rescued them. They would cut rates, and they might refinance. But there's less of those than the initial situation where everybody was in steady state, so everybody refinanced, or everybody has an incentive to refinance. And depending on, you know, their house, they may or may not do it instantly. Finally, think about this situation. You're lowering rates for a really long time, and then the Fed cuts rates. This situation, you're going to get 13% of people refinance and about a 0.6% rise in consumption. Now, the reason that's going to be true, why don't you get a very big kick there? Because if you look over here, right, you're still, it looks like everybody's going to gain if you refinance. But what you have to remember is a bunch of those people already refinanced and they already did the cash out refinancing. So a bunch of people aren't liquidity constrained anymore. And so when you cut rates from those low rates, you're not going to get that big kick from refinancing that you got when you just did it from steady state. Okay, so that goes exactly to the mechanism that Adrian was concerned about. So the final thing that we're going to do here is I'm just going to, maybe the best thing to do it is visually, is imagine that we start over here, the Fed cuts rates for a really long time, and then they normalize. Excuse me. So the Fed, so there's a common history, but over here you cut interest rates one period after you've renormalized, 2 periods after you've renormalized, or 3 periods. The question becomes, how long does it take for a given interest rate cut to have the potency it had when you started from steady state? Well, it turns out, just to remind you, when we started from steady state, aggregate consumption fell by 1.7% when I cut interest rates in steady state. If I do it over here, I only get 0.8% of a rise in consumption. Over here, 0.8%. But by the time I get to over here, the system has reset. That is to say, by the time you actually get a little bit of overshooting after, and this is yearly, right? So we're talking about 1 year, 2 year, 3 years. So the conclusion then is that the potency of the interest rate cut is substantially reduced for the first 2 years after the interest rate is normally. And why is that? Well, again, it's the same logic. Fewer people face a positive interest rate gap when the interest rate is cut relative to that steady state benchmark scenario. So you simply have to wait for new cohorts to come in, life cycle considerations to kick in, people are buying new homes, etc. So the bottom line is that monetary policy is less potent when interest rates are low. So you have to, and again, there's a bunch of statistics here about all of the exact intuition having to do with who's refinancing, etc. There's 2 ways to deal with the potency problem. One is sort of operational. If you're the head of if you're Madame Lagarde and you have to tell her, well, Madame Lagarde, you just have to cut faster, harder, right? So if you're going to be in that first period after you've renormalized, if you were normally going to think about a 50 basis point cut, you got to go 100 basis point. And the model is nonlinear, and so we talk about just how much bigger that cut would have to be. What we don't do, because the model is just too complicated at this point, is what do you do if you're Madame Lagarde and the ZLB is binding? Then you hit the ZLB before you can quickly take advantage of the model's nonlinearities, and you're out of bullets. In that situation, which we don't analyze, you then have to ask, if you think the ZLB is likely to be binding more frequently in the future than it was in the past, now you have an interesting trade-off. Do I save my bullets for this recession or the next one? That's a fundamentally different world. Now, we don't solve that problem with a bigger computer and better algorithms. Maybe we could, but that seems like an obvious next step for us to take, right? But that's not in this paper. So let me just conclude. I know I've gone over and I apologize. I hope I've convinced you empirically that monetary policy is state dependent, that there's an important cost of fighting recessions with with a prolonged period of low interest rates, especially if you're worried about the ZLB, and that there are mechanisms that this model say are important that aren't in traditional Hank models, and they're also not in traditional DSGE models. They're another interesting example of what Gilles said, institutions that are real and vary across countries, right? So we could now ask, well, France has a different mortgage system than the US. This kind of a model has very sharp predictions for how potency of monetary policy from the refinancing channel varies as a function of the mortgage institutions in place in any given country. So I'll stop with that.
Okay, thank you very much for this very stimulating lecture. Now we have some time for questions and comments from the floor.
Can I ask a question about the impact of falling refinancing costs on your estimates or your results? So
I love it. Yes, please do.
isn't there evidence that refining has become a lot easier in the United States over your sample? So I wonder if, to the extent that you take averages, whether that impacts your results.
The first round of this paper, so you're absolutely right. So in the first round of this paper, we made a big deal of studying exactly that question. What would be the impact on monetary policy of lower refinancing costs? Now that's of independent interest, right? So and the answers are obvious, right? You would get less state dependency in the process as average refinancing costs went down. And so we worked all that out, and et cetera. The other thing, though, it's still quite remarkable. The question then becomes, what's the relevant cost for refinancing? There's a pecuniary refinancing cost, and there's the non-pecuniary cost of just doing it, right? Which takes us a little behavioral. So there is a fixed cost of thinking about this problem, which is quite real. And if you look at the interest rate gaps, it's one way to say, have they really gone up or down? Which is more important? There's still a lot of interest rate gaps, and a lot of your friends that should have refinanced didn't yet. I would say now in this cycle, there was a great article in the thing in the Wall Street Journal. We've had a real refinancing boom. As interest rates have come down, the mechanism in the model is really kicking in, and that's really helped the Fed.
Thanks.
Sure.
One question I have, Marty, is on, I'm very intrigued and I mean, completely on board with this idea that there is much more than intertemporal substitution. And this refinancing is a very natural component of kind of the cash flow effects of monetary policy. But whenever you think about this question, there's always the cash flow on the other side, right? So the guy that was receiving the high interest now is no longer receiving as much interest. So I wonder to which you can speak to that and think about maybe potential offsets from that. And
I can. We did it. I'll give you a Hank-like answer, which is that if you think, we said, suppose the bankers are not particularly liquidity constrained. In fact, suppose they're PIH guys. So in the model, we said, let's take all the refinancing gains of the model, give them to PIH bankers, and deduct that from aggregate consumption. It turns out it's pretty small for the obvious reason that they're PIH guys. So that offset, if they're low MPC guys, is not going to be very big. I forget the exact number, but it's in the paper. Yeah, so we're pushing hard on this liquidity constrained Hank thing here, because it really wouldn't make sense in a PIH world. None of this would make any sense. If everybody was PIH, taking $1 from me, giving it to you, it can't matter.
I'm lost. Is it true that in your model, by refinancing, I impose a tax on my banker?
Yes, it is.
I force a transfer from my banker?
No. So let me be clear. Remember, it's a partial equilibrium model. So the model per se is just looking at the winners. So Adrian correctly says, well, what about the losers that are outside your model? So,
right, but I mean, when I borrow from a bank, I sign a contract saying I pay you X every month, right? I cannot renege on this contract. I can sell my loans to another institution, but the other institution is going to compensate my bank, no?
well, I'm not sure what you mean now, Gilles. Let me be very clear what I did do and what I didn't do. So we're just looking at the gains from refinancing, car loans, all those other things. I have nothing to say about that. What Adrian's pointing out is even if I just look at refinancing loans, my consumers gained, let's say, $100. What that means is the owners of the bank lost $100. That must be true.
That's
right?
true in the United States. Maybe in France, it's really costly to refinance fixed rate loans. So maybe this is where your question is coming from.
No,
Well,
I have a credit. I borrow from you, okay?
Yes, yes.
Now, I commit to pay 100 per month, okay? So that's a legal contract.
Well,
So
the question is,
I cannot change the terms of this contract without your agreement. There could be a third party which would pay you a fixed cash amount so that you agree to renounce the loan. But there is no reason why you should agree if this is a loss to you. The terms of the refinancing have to be profitable for all parties involved.
So now we get into the
you cannot lose money. It's just a Pareto improving change in the rescheduling of the terms of the loans, which must be Pareto improving for all the parties involved.
So Gilles, this has to do with the nature of the contract and the institutional reality. In the United States, it is the contract does not say I can't prepay the mortgage. I can pay off so I can go, if Adrian wants to lend me money to pay you off as my banker, there's nothing in the contract that prevents that. That is just, so then I can do that.
I paid off. I get the PDV of what you owe me. So I don't lose 100, I lose 0.
Well, no, you will be paid the balance.
Unless you have a variable rate, in which case you are somewhat automatically refinanced.
Well, that's an interesting question. The question was how was that loan set and whether in fact there are any losses to the banker. What I have to think about. Now I'm confused.
I mean, the lenders protect themselves against, so they offer this fixed rate contract that if the rates fall, you have the free option to refinance it. That's how it is in the United States. So then they protect themselves ex ante by, say, charging a higher interest rate to begin with, because there's interest rate risk in the contract. But
so
it's ex ante, I think.
So it's actually a variable rates contract in some sense.
It's like you can pay a long-term bond at par if you want, even if interest rates rise.
Well, that's right. I mean, if I borrowed $100, I can just give you the money.
Right. Exactly. And then you
lose.
Yeah, this is what I thought was going on. Right.
No, but so now I'm not sure what.
You will borrow from a bank on, I don't know what, longer terms, and the bank pays your initial bank back. Okay. But if it's a clause in the initial loan that allows you to refinance at a loss to the lender, this is a form of variable rates in some sense.
Well, the contract just says
a variable rate with a cost to adjust the rate.
Well, the contract in the United States typically says that I borrowed $100. If I owe you $60, at any point in time, there's a principal that I owe my bank. If I somehow come up with the money to give you that principal, I'm done.
Right. So you owe me 60, you owe me 60, right?
Yeah, that's it. So I pay you off. And
so you cannot force me to pay you. You cannot prevent me from getting those 60s.
No, but that's not what these refinancing guys are paying off their balance. If we go back to the original contract, right, there was a principal that they owe at every point in time and an interest rate payment they're making. I'm just going to pay off the principal.
Okay. Right.
Can I ask
That's the idea, right?
Can I ask a question about the asymmetry of?
Okay, so basically it's equivalent to borrowing the principal to pay it back, right?
Precisely. That's exactly what
In
it
the
is.
Modigliani-Miller world, refinancing is a meaningless concept.
Well, but remember, these guys are lucky. They can get a cheaper loan. For some reason that had nothing to do with them.
Right.
You
But
get
that's
the-
because interest rates went down, right? If I
Yes,
was,
yes. Oh, absolutely.
Right. I
Absolutely.
mean, if I borrow 60 to pay you back, or if I continue to pay my loans to you and borrow 60 to do something else, this is exactly equivalent.
Well, but
Does
I'm
not
very,
change anything.
But the key is that the outstanding, once the interest rate fell, the outstanding, the present discounted value of the remaining loan has gone up, right? And you still have the ability to refinance it at the face value. That's the key thing, is that the fall in the interest rates that has occurred increases the present discounted value of your liability that's remaining, and that's discounted at a fixed rate. So I think that's
It's like having a put option on a long-term bond at par.
yes, exactly. That's exactly right. I mean, that's what the ability to refinance
That's
is.
the idea, yeah.
Can I ask a
Right.
question
Now,
about the
that's because
asymmetry?
my existing loan, yes, this happened to me the other way around. My bank refinanced itself by reimbursing consoles. Well, consoles, they were not consoles to me. I had the bonds from my bank, and one day I woke up in the morning and I had cash enough instead, right? So
Yep.
they refinanced, they paid me back.
I'll tell you guys a funny story at the end, but I want to let Tobias have his question.
Thank you. I just wanted to say your model is, has an obvious state dependency in the effect of rate cuts, but it also has an asymmetry in like normal times between rate rises and rate cuts. I just wanted to ask you whether you had, evidence that the model matches those.
It's a great question. So, it's actually this model. So the truth is, in the US data, we've had many more interest rate cuts than rises. And so the standard error, so I could just do that regression separating out declines in the interest rate and rises in the interest rate and ask, are they very different? They are, but the standard error on the effects of rises is pretty big. So I statistically can't give you a very clean answer. So it seems to me there is definitely a falsifiable. Now, there could be other reasons that, we're only looking at the refinancing channel. So you could imagine other reasons why in the data will go the other way. We're only looking at the refinancing and that's all we're claiming. It's a big leap to go therefore and say all in for all the 5,000 reasons money isn't neutral. There's this asymmetry. So we're being modest, and in the data, the truth is many things are possible because of standard errors on the rate hike side. The little story I'll tell you is when I first started thinking about this, I used to have a fixed rate mortgage when mortgages were 10, 11% in the old days before most of you were born. And it turns out that there was a guy, Blumenthal, who worked in the White House. And he was a very good guy, but his brother wasn't. He was a mortgage broker. And for some reason, got to know him. And he said, I have a great idea. Banks follow these mortgages for about 2-3 months, and then they securitize them. And they don't know what happens to them. He said, it turns out that if I can convince, they will pay me as a mortgage broker a bonus if I sign you up to a stupid mortgage. They called it a doctor's mortgage. So if you would pay a big interest rate on a 30-year mortgage, they made so much money on that, they gave half back to him. He said, I'll give half of what I make back to you. And there was enough there that if I refinanced every 3 months, I could cut my mortgage rate by about 1% or 2 percentage points. So this guy's name was Ed Blumenthal, and I refinanced with this guy every 3 months for 10 years till I paid off my mortgage.